The IRS is deploying technology right now that simply did not exist 2 years ago to detect errors on your tax return connected to your home. And if you are a homeowner over the age of 60, there is a very real possibility they have already identified one of yours. That is not speculation. That is what happens when you give the IRS $80 billion in new funding and direct them to build a system that cross-references every county deed record, every mortgage lender report, every Airbnb payment, and every estate filing in the country against every tax return on file. That system is operational right now. It is identifying discrepancies, and the people it is flagging more than anyone else are seniors who own homes with substantial equity. I'm going to walk you through exactly what the IRS is looking for, the 4 specific transactions that are triggering automatic flags on senior homeowners, and the 5 steps you need to take before May 19th to protect yourself. But I need to share something with you first that most people do not understand about how this works, and it changes everything about how seriously you should take the next 20 minutes. Here is what shifted. For decades, the IRS operated with a limited budget, outdated computer systems, and insufficient staff to actually verify whether your tax return matched reality. Audit rates dropped to historic lows. Compliance gaps went undetected for years. Millions of Americans, many of them seniors, were making completely normal financial decisions involving their homes without ever being informed. Those decisions carried tax reporting requirements. They added a child to the deed. They took out a home equity line of credit for medical expenses. They rented a spare bedroom on Airbnb. They inherited property from a spouse or parent and simply continued living in it. Every single one of those actions trigger a specific IRS reporting obligation. And for years, almost nobody was caught because the IRS simply did not have the tools to check. That era came to an end in 2022 and 2023. Congress authorized approximately $80 billion in new IRS funding through the Inflation Reduction Act. A significant portion of that money went directly into enforcement and technology. The IRS used it to construct automated data matching systems that pull information from sources that were never connected before. County property records, mortgage lenders, home equity loan servicers, title companies, short-term rental platforms like Airbnb and VRBO, estate and probate court filings. All of that data now feeds into machine learning systems that compare it against every tax return associated with the property owners involved. The system is not looking for suspicious behavior, it is looking for discrepancies. A deed transfer with no Form 709, a 1099-K from Airbnb with no Schedule E on your return, a home equity loan with a claimed interest deduction that does not align with the loan's stated purpose, an inherited property sale with no documented basis. These are not judgment calls, they are mathematical comparisons. And when the system finds a discrepancy, it generates a notice automatically. By the time that notice arrives in your mailbox, the analysis is already complete. The IRS is not asking whether there is a problem, they are informing you they already identified one. Now let me walk you through the 4 specific triggering events because there is a strong probability that at least one of them applies to you or someone you care about. The first and most common trigger is out a home equity loan or a home equity line of credit and using the funds for something other than home improvement. This has become extremely common among seniors over the last several years. Inflation has driven up the cost of groceries, utilities, prescription medications, and everyday expenses. Millions of older Americans have turned to their home equity as a financial resource. Maybe you took out a HELOC to pay off credit card debt. Maybe you used it to help a grandchild with college tuition. Maybe you needed it for a medical procedure that insurance did not fully cover. Those are all completely understandable decisions. But here is what your lender almost certainly did not tell you. Under current tax law, specifically the Tax Cuts and Jobs Act of 2017, which remains in effect, home equity loan interest is only deductible if the loan proceeds were used to buy, build, or substantially improve the home that secures the loan. IRS Publication 936 makes this clear. If you use the money for anything else, medical bills, debt consolidation, tuition, living expenses, the interest is not deductible, period. And if you or your tax preparer claimed that interest as a deduction on Schedule A of your return, you now have an incorrect deduction on file that the IRS can identify through their lender data matching systems. The penalty structure begins with the additional tax owed on the amount that should not have been deducted, plus interest calculated from the original due date of the return, plus a potential accuracy-related penalty of 20% of the underpayment. For a senior on a fixed income, that combination of back taxes, interest, and penalties can easily reach several $1,000s. The second triggering event catches more people off guard than almost anything else. It is adding a family member to your home's deed. Millions of seniors have done this with the best of intentions. You add your adult son or daughter to the deed, so the house transfers to them automatically when you pass away without going through probate. Or someone advised you it would protect the home from Medicaid recovery. Or you simply wanted to make things easier for your family. Those motivations make complete sense from a family planning perspective. Snorts. But from a tax perspective, adding someone to your deed is not a simple administrative change. It is a transfer of a partial interest in real estate, and the IRS treats that transfer as a gift. Under the Internal Revenue Code, the transfer of property by gift is a taxable event when the value exceeds the annual gift tax exclusion. For 2026, that exclusion is $18,000 per recipient. If your home is worth $400,000 and you added your child as a 50% owner, you transferred $200,000 in value. That means you are required to file IRS Form 709, the United States Gift and Generation Skipping Transfer Tax Return, for the year in which the transfer occurred. Not filing that form when required is a reporting violation that carries its own penalty. And here's the part that makes this particularly significant. When you give property as a gift during your lifetime, the recipient receives your original cost basis, not the current market value. That is called carryover basis. But when someone inherits property at death, they receive a stepped-up basis, meaning their basis is the fair market value at the date of death. The difference between those two outcomes can be enormous. If you purchased your home for $80,000 30 years ago, and it is now worth $400,000, your child inheriting it at your death would receive a stepped-up basis of $400,000 and could sell it with little or no capital gains tax. But if you gifted them a 50% interest while you were alive, their basis on that half is only $40,000. If they sell after your death, they could face capital gains tax on the difference between $40,000 and whatever the home is worth at that time. We are talking about tens of thousands of dollars in unnecessary tax liability, created by a decision that was made with good intentions, but without complete information. And the IRS is now identifying these unreported gift transfers by cross-referencing county deed records against Form 709 filing records. If a deed change appears in county records, but no corresponding form was filed, the system flags it automatically. The third triggering event involves rental income from your primary residence. This one has expanded significantly because of how easy platforms like Airbnb and VRBO have made it to rent out a room, or even your entire home while you travel. For seniors on fixed incomes, the extra few $100s a month from renting a spare room can be genuinely meaningful. It can mean the difference between covering your property taxes comfortably or falling behind. The appeal is completely understandable. But the moment you begin receiving rental income from any portion of your primary residence, you have changed the tax character of that portion from personal use to income-producing use. That means the rental income must be reported on Schedule E of your tax return. You must properly allocate expenses between personal use and rental use. And critically, you must account for depreciation on the rental portion, which affects your cost basis and therefore how much taxable gain you will have if you ever sell. Under current enforcement rules, platforms like Airbnb and VRBO are required to issue Form 1099-K to any user who receives more than $600 in gross payments during the tax year. That form is sent simultaneously to you and to the IRS. So if you received rental income through one of these platforms and did not report it on your return, the IRS does not need to audit you to find out. They already have the data. Their matching system compares the 1099-K against your filed return. When the income doesn't appear on Schedule E, the system generates a notice. The most common notice is the CP2000, which is an automated underreporter notice. It is not an audit. In some ways it carries similar weight because it is a computer-generated assessment that assumes you owe the tax on the unreported income plus interest, plus a potential accuracy penalty. And if you do not respond within 60 days, the proposed assessment becomes final, and the IRS can begin collection actions, including filing a federal tax lien against your property. The fourth triggering event is the inherited property documentation gap. This one is especially difficult because it typically affects people who are navigating one of the most challenging experiences of their lives when the mistake was made. When you inherit property, whether it is your deceased spouse's share of the family home or a vacation property from a parent, the tax code provides one of its most valuable benefits, the stepped-up basis. This means your cost basis in the inherited property is the fair market value at the date of death, not what the original owner paid decades earlier. This is enormously beneficial because it can eliminate or dramatically reduce capital gains tax if you later sell. But the stepped-up basis only works if it is documented. If the estate did not obtain a qualified appraisal at or near the date of death, if no Form 706 was filed for estates that met the filing threshold, if no records were created establishing the fair market value at the time of inheritance, then you are holding property with an undocumented basis. And under the IRS's current enforcement posture, an undocumented basis is treated as a zero basis until proven otherwise. That means if you sell an inherited property for $300,000 and you cannot document what your stepped-up basis should have been, the IRS can assess capital gains tax as if your basis was zero. On $300,000 of gain, that could mean a tax bill of $45,000 to $70,000 or more, depending on your income and filing status. And the IRS is now actively identifying inherited properties through estate filing records and probate court data, and matching them against subsequent sale records to determine whether the proper basis documentation exists. Now, I understand the question forming in your mind. How could the IRS possibly track all of this? How could they know you added your daughter to the deed 3 years ago? How could they know you rented your basement on Airbnb last summer? How could they know your mother's home was never properly appraised when she passed? The answer lies in what makes 2026 different from every year before it. County recorder offices in most states now have data sharing agreements with the IRS. When a deed is recorded, when a title is transferred, when a lien is filed, that information enters a federal database. Mortgage services report loan originations, balances, and interest payments directly. Title companies report closing transactions. Rental platforms report payments. Estate and probate courts report filings. All of it feeds into the same system. The system does not pause. It does not take weekends off. It processes millions of records simultaneously and never misses a match. So, what do you do? Let me give you 5 specific steps you can take right now. Step 1. Gather every document related to your home and your home finances going back to 2022. Your original purchase documents, the closing disclosure from when you bought the home, records of every major improvement, a new roof, a kitchen renovation, a bathroom addition, new windows, a new HVAC system. Under IRS Rules and Publication 1523, the cost of permanent improvements increases your basis, which reduces your taxable gain when you sell. Many seniors have invested tens of thousands improving their homes over decades, but never maintained organised records. That missing documentation could be costing you real money. Then locate any home equity loan or HELOC statements, the original loan agreement, annual statements, anything showing what the funds were used for. Find any deed or title documents showing ownership changes. And if you have been renting any part of your home, gather your income records and platform statements. Step 2. Take your last 3 filed tax returns and compare them against those documents. You do not need to be a tax expert. You are simply looking for things that do not align. Did you take out a HELOC, but there is no mention of it on your return? Did you change your deed, but there is no Form 709 in your records? Did you receive rental income, but there is no Schedule E? Did you sell or transfer property, but there is no Form 8949 or Schedule D? You are not solving the problem yet. You are determining whether one exists. Step 3. Bring what you found to a qualified tax professional, specifically a certified public accountant or an enrolled agent with experience in real estate taxation and IRS penalty procedures. You can find an enrolled agent through the National Association of Enrolled Agents. You can find a CPA through the American Institute of CPAs. When you call, ask one question. Do you have experience with IRS penalty abatement for real estate-related compliance issues? If the answer is yes, you have found the right person. Step 4. Create an account at irs.gov and access your tax transcript. This is one of the most powerful and underused tools available to taxpayers, and it is completely free. Your transcript shows every return processed under your Social Security number, every notice or assessment issued, and every piece of third-party data reported to the IRS matched to your account. Every 1099, every W-2, every 1099-K from rental platforms, and K from setting up the account takes approximately 15 minutes through a process called ID.me. Once you are in, you can see exactly what the IRS sees. If there are pending notices you are unaware of, they will be visible there. This is how you stop guessing and start knowing exactly where you stand. Step 5. If you have IRS notices you have already received but have not responded to, address them immediately. Every notice has a response deadline. If it is not passed, respond before it does. If it has passed, contact a tax professional right away, because an unanswered notice does not disappear. It escalates. An unanswered CP2000 becomes a statutory notice of deficiency. That becomes a final assessment. A final assessment becomes a collection action. A collection action can become a federal tax lien on your home. That progression unfolds over months, but every step makes the situation more difficult and more expensive to resolve. And I need to caution you about something just as concerning as the penalties themselves. The scammers. Every time there is a high-profile tax issue affecting seniors, fraudulent activity increases within days. Individuals claiming to be IRS agents demanding immediate payment. Emails with official-looking logos asking you to click a link. Companies promising to make your problems disappear for a large upfront fee. The real IRS initiates contact through United States Postal Service mail. They do not call demanding immediate payment. They do not threaten arrest over the phone. They do not accept gift cards, wire transfers, or cryptocurrency. They do not send emails requesting personal information. If anyone contacts you and creates urgency around immediate payment, it is fraudulent. Hang up. Delete the message. Here is the bottom line. The IRS has more data, more technology, and more enforcement capacity in 2026 than at any point in its history. Senior homeowners are being flagged at higher rates than any other group for unreported property transactions. The window to come forward voluntarily and take advantage of penalty relief provisions is open now, but it narrows considerably after May 19th. The steps are clear. Gather your documents, compare them to your returns, consult a qualified professional, check your IRS transcript, respond to any outstanding notices immediately. You did not create this situation intentionally. Most people affected made perfectly reasonable decisions about their homes without anyone explaining the tax consequences. But understanding that does not change what needs to happen next. What changes your outcome is action. Informed, timely, specific action taken before the deadline. If this gave you clarity, share it with anyone over 60 who owns a home. That one share could save someone thousands of dollars. Subscribe because these updates continue throughout 2026 and drop your questions in the comments. Your situation could become the subject of the next video. I will see you in the next one.